Bloomberg Audio Studios.
Podcasts, radio, news.
For most of this year, there was only one direction major stock indices like the S&P 500 and NASDAQ were headed. And that direction was up.
An S&P 500 at 5,300, a fresh record high for the Dow Jones Industrial Average, a fresh record high for the NASDAQ Composite and the NASDAQ 100.
So we have record highs for the three major indexes and a second day of record highs for both the S&P 500 and the NASDAQ.
Yesterday, the Stock 600 closed at a fresh record high. That's 8 days of gains. Equity markets are on a tear.
But this week, that euphoria came crashing down.
The majority of the names are certainly down.
Tesla shares falling more than 12% today, the biggest drop since September of 2020.
Down on the day. So at least in equities, it's hard to find a place to hide today.
On Wednesday, the S&P 500 fell by 2.3%, ending its longest streak without dropping by 2% or more in 17 years, according to Bloomberg data. And the tech-heavy NASDAQ saw an even more dramatic sell-off.
The NASDAQ, the worst of the bunch, losing more than 3.5%. Again, these are the biggest declines since late 2022.
Markets recovered a bit to end the week, but for some, this week's sell-off didn't seem like just a blip. Instead, it could be the beginning of a new era in markets. Today on the show, welcome to the Great Rotation. Is everything we thought we knew about markets this year about to flip? I'm Sarah Holder, and this is The Big Take from Bloomberg News. To understand the week that was in markets, I spoke to Isabelle Lee. She's a reporter on Bloomberg's cross-asset team.
A lot of people wonder what that is, but we cover more macro trends and the niche parts of the markets that you wouldn't really think of in the beginning. But our team is the best team.
The Big Take team might argue with that one. But anyway, when it came to markets, I started by asking Isabelle about the positive and asked her what it was that was propelling markets up and up and up for the majority of this year. So Isabelle, let's go back in time to, say, 3 weeks ago. The S&P 500 and the NASDAQ hit another record high. What was behind that rally?
It's just really the euphoria surrounding artificial intelligence. It all began when ChatGPT was introduced to the markets, or at least when people were aware of ChatGPT. Since then, big tech just rallied and broke record after another. I think this year, markets broke records like more than 30 times.
And then when did you and the Bloomberg Markets team have a sense that something might be shifting? What were the first warning signs?
I think it's safe to say that it all began around July 11. That's when the CPI report came out, and it came out softer than expected. So that's good because it showed CPI was cooling to the fastest pace since 2021. And many read this as a sign that the Fed can cut rates. At this point, it's really just a matter of when, not if. So that was the day we saw a massive rotation.
A massive rotation. According to Isabelle, July 11th was when what some are calling the Great Rotation began. And it's all because investors started to really think about what lower interest rates might mean for companies, and in particular, smaller companies. I asked Isabelle to define this Great Rotation in a sentence.
I think in a sentence, it means a shift in dominance with whoever is outperforming in the market. So for the longest time, it's mega cap tech stocks, the tech behemoths, the big companies. And now we're seeing potentially small caps, which are basically smaller companies. Small caps means smaller capitalization. They have smaller market values. And everyone's saying that they will benefit from lower interest rates. So why? Generally, small caps are just more sensitive to interest rates than the large caps because they're more levered. And easier monetary policy, which means if the Fed cuts, would mean there are less chances of recession. And if there are less chances of recession, it'll benefit smaller companies.
Small caps are more levered, which means they have more debt. Their fates are also more closely tied to the health of the typical consumer. And now it's looking like the economic case for a rate cut has only gotten stronger, which for those reasons would benefit these mom-and-pop companies more. So on July 11th, the Great Rotation towards small caps started.
That was the day where we saw the Russell 2000, so that's a gauge of small cap stocks, beating the NASDAQ 100, a gauge of big cap stocks, by 5.8 percentage points. So at that point, that was the most since November 2020. So this was, I think, the beginning of the shift, or the so-called rotation.
And that shift accelerated. On Wednesday of this week, the S&P 500 and NASDAQ fell by 2.3% and 3.7%, respectively, the most since late 2022. I asked Isabelle what was behind this sell-off.
So it was really the lukewarm earnings we saw the day prior after market close. Alphabet reported earnings. They reported a bloated capital expenditure. Tesla also reported earnings, and it was a miss. And they delayed again the robo-taxi. So it really got investors thinking, when are we going to see the return on investments on everything they're spending on AI? They're lavishing billions of dollars on that. But obviously, it's not going to happen overnight. It's a marathon, not a sprint, so to speak.
Right. Does it mean that they're getting disillusioned with AI? And what would have to change for them to get excited again?
It really depends. In markets, there are always two camps. And of course, there's the camp that says it's a bubble. It will burst soon, and it's just a matter of when. But then the other camp is like, no, we believe in these companies. We believe in their fundamentals, their balance sheets. Like, how can this be not the future of tomorrow? And I mean, if you look at the companies that are powering the rally, they're just really getting bigger and bigger.
Well, what went through your head when you saw those huge dips this week?
Well, the first question was, does this rotation have legs? Like, is this the beginning, or is this just a blip? Now it looks like it's just a blip. But again, it still depends on who you ask. I think we're just in the early days.
The early days. Isabelle pointed out that of the so-called Magnificent Seven, only Alphabet and Tesla have reported. There's still Microsoft, Meta, Amazon, and Apple to go. And then this year's stock market darling, the chipmaker NVIDIA.
Which a lot of my friends are the most excited about. There's so many memes online about NVIDIA, about how all their employees are just mega rich. Anyway, they set to report on August 28th. So it's still a month from now.
Well, how is NVIDIA doing?
NVIDIA is, year to date, it's up more than 200%. That's kind of crazy. Microsoft is up just more than 20%. So it's not even a close call. It just really underscores how NVIDIA is the biggest beneficiary by far of this AI trade. I mean, 20% is good, but if you compare it to 200, it's really a wow.
Yeah. Why is it valued so high? Is it overvalued?
I mean, there are many reasons why stocks go up, but it's really just investor enthusiasm because they were early in the game, and the demand for chips, especially in this area, is really, it's still incredibly high. And NVIDIA is just poised to capture all of that. And they're also one of the first movers and the biggest. I'll never forget this. Again, I spent too much time on Twitter, but I saw this like meme of how Intel used to be way bigger than NVIDIA in terms of market cap. And now NVIDIA is just leaps and bounds.
Well, it's funny because you're saying that, you know, some of what we're seeing in the market is potentially investors getting disillusioned with AI or some of that excitement cooling down. NVIDIA is kind of an exception to this still. What are you looking out for when NVIDIA reports?
The thing with these mega cap companies is a lot of them report good earnings, but it's just that expectations are so lofty that even good earnings sometimes don't cut it. Here's the thing. A lot of the Magnificent Seven stocks, their earnings are now macro events. They're not anymore just like earnings. You know, oh yeah, I'll just read it the next day. It's like a macro event, and the stock market moves with them.
It can change everything.
Yes, because their concentration is just so huge. It's like some 30% of the index. Can you imagine? So that's why, however they move, the market kind of moves in lockstep.
So the expectations for the Magnificent Seven were so high that even good earnings might not be enough to appease investors. And that fact, coupled with the reality that interest rate cuts benefit smaller companies more than big tech firms, means that we've been seeing a shift. I asked Isabelle if that means that the Russell 2000, the index of all these small cap stocks, was the place to be.
It depends on who you ask, but it's always good to, I'm going to sound like a boring portfolio manager or a responsible portfolio manager.
Never, Isabelle.
But you should always really diversify, because now you could see that, for instance, we're writing about this mutual fund that was the best performer year to date. And it really basically held a lot of the mega cap tech stocks. Its top 6 holdings are the Magnificent Seven, except Tesla, basically. And year to date, they were the best performer among all of the mutual funds that Bloomberg tracks. But if you look at them month to date, they sit among the worst performers. And that just shows what an overly concentrated portfolio looks like, which speaks to, again, diversifying. But also, honestly, if you have that much conviction, then good for you, because when you win big. Just depends on your risk tolerance.
Coming up after the break, how to tell if this great rotation is just a blip, and what to do if it's not. Markets are having a bit of an anxious moment. Is the euphoria of AI's potential to transform the world wearing off? Or is this just a blip? I asked Bloomberg cross-asset reporter Isabelle Lee when we might have an answer. And she said that we're still early in earnings season. 60%, or 3/5 of companies in the S&P 500 are still left to report. Analysts estimate that the index will see second quarter profits rise around 9.3% year over year.
So that's a good thing because that's the biggest such expansion since the last 3 months of 2021. And that's according to data by Bloomberg Intelligence. So it's still looking to be a good earnings season. But again, how good depends on investor expectation. It still remains to be seen.
Well, let's get into some of those macro events that might be impacting the markets. We've been seeing a lot of releases that have bolstered the case for the Fed to cut rates at its meeting in September. How is all of that Fed chatter impacting what we've been seeing in markets?
So the consensus is markets is still expecting a rate cut in September. But we have some, like Bill Dudley, who is a former New York Fed president and Bloomberg opinion columnist, who now calls for a rate cut in July.
One of the interesting sort of quandaries of the Fed is in right now they've telegraphed it pretty clearly that they're going to move in September. And it sort of begs the question, if it's so obvious that you need to move in September, then what are you waiting for? Why not just move in July?
But Isabelle says that a cut in July versus a cut in September isn't going to be that big of a deal for markets.
It's just 25 basis points. In the grand scheme of things, that doesn't matter a lot. We're going to see a ton more. And it's just 3 months. I mean, we've had this elevated interest rates for like over 2 years. So to some, it doesn't really matter. They just want clarity.
Something else that's probably making everyone's job a little harder is all of the political news that we've had in the U.S. over the past couple of weeks that I assume have made some sort of impression on the market. There was the attempted assassination of Trump. Biden stepped down and endorsed Kamala Harris last weekend. How is this dramatic news cycle and the U.S. presidential election more broadly showing up in these numbers?
That was a big question, actually. Now it's just becoming a lot more noisy, and we don't know why markets or why some asset classes move. So I was also working that weekend, and the sense that I got from the people I bugged and who were kind enough to reply to me was there was a sense of calm, because if she, at that point, they were like, okay, then if she ends up being the nominee, then we can finally get clarity that it's going to be Harris versus Trump, because there's been so much chatter about, will Biden step down? So when, blah, blah, blah. And the next day, actually, after that, stocks rebounded after the worst week in April. But I don't really think it was because of Harris. It was really more investors positioning ahead of the earnings cycle, which, again, purely from a market's perspective, is really what's important. And some managers I talked to were like, okay, good. For now, we can pause with this political noise because we have Trump and Harris, and then we can focus on earnings.
Well, how do stocks tend to perform on election years?
So I have tidbit about that. So since 1928, data from Bloomberg Intelligence shows that the S&P 500 has gained roughly 5% on average in the third quarter of election years. So in general, this logs positive returns nearly 2/3 of the time from the June to September period.
Interesting. So, Isabelle, there's like this golden rule of economics podcasting where if you try to make an episode about markets going down, markets will inevitably go up on the day you publish. That upswing is likely here already, as you mentioned. So after all of this, is what we're seeing just a normal market fluctuation, or is it a sign of some deeper problems brewing?
You're going to be annoyed with me because I'm going to play it safe, and I'm going to be every podcast host's nightmare because I'm going to say it's too early.
Okay, when will we tell? When should we have you back?
Honestly, I think towards the end of the third quarter, because then the election season will really have picked up, and then earnings season would have been done. We would have seen whether the Fed indeed cut in September. But then if you ask me again at that time, I'm probably going to say fourth quarter. And then fourth quarter, I'm going to say 2025. But on a serious note, I think towards the end of the third quarter, we'll see more clarity.
Got it. Well, we'll be calling you back. So, Isabelle, given all this, what's a regular person with some money in the stock exchange supposed to do? How should we be thinking about this?
I'm going to echo what everyone does and what I personally do, actually. I just dump everything in index funds. I mean, yes, you don't see spectacular gains. Like, oh my gosh, if I have NVIDIA, I would probably have a down payment for a house right now. But index
for now.
For now, yes. But index is safe. And I mean, the way I look at it is, it's for retirement. It's for when I'm old and hopefully just sit by the beach and sip coconut juice, so I just dump everything in the index.
Wise words.
Boring, right? But safe.
Boring, but safe. If it gets you on a beach with some coconut water, I guess that could be good enough. To stay in the loop with the latest market moves, you can find all of our coverage at Bloomberg.com/markets. This is The Big Take from Bloomberg News. I'm Sarah Holder. This episode was produced by David Fox. It was fact-checked by Thomas Liu and Adriana Tapia. It was edited by Sid Verma and mixed by Alex Sugiura. Our senior producers are Naomi Shavin and Kim Gittleson, who also edited this episode. Our senior editor is Elizabeth Ponso. Nicole Beamsterboer is our executive producer. Sage Bauman is Bloomberg's head of podcasts. Thank you so much for listening. Please follow and review The Big Take wherever you get your podcasts. It helps new listeners find the show. We'll be back on Monday.